A garbage truck rolls onto a scale, pauses for a few seconds, and leaves behind a number. That number determines what the landfill will charge for the load. From the outside, the transaction looks almost absurdly simple. A customer brings in something nobody wants, pays to surrender it, and drives away. The landfill keeps the money and the material. But three financial events have just happened at exactly the same time. The landfill has earned revenue. It has consumed part of its remaining capacity, and it has created a small piece of a future environmental obligation that may not be paid for decades. That is the paradox at the center of this business. Every profitable load moves the landfill one step closer to the day when its primary source of revenue ends. So the real product is not garbage disposal. It is the legal right to fill a limited amount of empty space. And to understand whether owning a landfill is actually profitable, we have to follow that space from the moment it is permitted, through every ton placed inside it, all the way to the bills that continue arriving after the final truck is gone. Start with the physical property. A landfill may occupy hundreds of acres, but an owner cannot automatically bury waste across every acre that appears on the deed. Some land holds access roads, offices, stormwater systems, buffer zones, gas equipment, wetlands, or areas that have never been permitted for disposal. That distinction is enormous. At the end of 2025, Republic Services reported 207 active landfills with roughly 118,918 total acres. Only 41,158 of those acres were permitted. Across the portfolio, the company estimated about 5 billion cubic yards of available disposal capacity. Those numbers describe one of the largest integrated waste companies in North America, not a typical independent landfill, but they expose the real unit of inventory. The valuable part is not simply acreage, it is permitted airspace. Accountants and engineers begin with cubic yards because a landfill is fundamentally a three-dimensional asset. Then they convert that volume into tons, using the density the site expects to achieve. That conversion is not universal. Food waste, demolition, debris, bulky furniture, soil, moisture, equipment, and the skill of the compactor operator can all change how much material fits into the same volume. Two landfills with the same permitted shape can have different economic lives because one achieves better density. This makes compaction more than an operating task. It is inventory management. If a landfill can safely fit more tons into each permitted cubic yard, the owner has effectively increased the amount of saleable capacity without purchasing another property. A small improvement repeated across millions of cubic yards can extend operating life and create significant additional revenue. But even perfect compaction cannot solve the larger constraint. Eventually, every permitted cell reaches its approved elevation. Why not buy the neighboring field and keep going? Because ownership of the land and permission to use the land are separate assets. Modern municipal solid waste landfills in the United States operate under federal standards implemented through state programs, along with local zoning, environmental review, engineering approval, and community restrictions. The process is designed that way because the consequences of a poorly located or poorly operated landfill can continue long after the original owner is gone. An applicant may have to study groundwater, geology, wetlands, traffic, air emissions, wildlife, noise, odor, stormwater, and the effect on surrounding communities. The design must explain how the site will contain waste, collect contaminated liquid, control gas, monitor groundwater, and eventually close. Then the owner has to convince regulators that the money will be available to perform those obligations in the future. Financial assurance can take different forms, including surety bonds, insurance, letters of credit, trust arrangements, or approved financial tests. The exact requirements vary by state and facility, but the economic message is consistent. The owner cannot take all the current cash and pretend the future cleanup belongs to someone else. This process also creates the industry's strongest barrier to entry. In a 2024 presentation, Charlotte County, Florida, estimated that designing, permitting, and constructing a new landfill expansion could take 5 to 6 years. A competitor with money cannot instantly open a facility across the street. It needs suitable land, technical approval, political tolerance, financing, and time. That delay can make an existing permit extremely valuable. It can also trap an owner who waits too long to apply for additional capacity. A landfill with 5 years of space remaining and a 6-year expansion process does not have a comfortable schedule. It has a countdown, and receiving the permit only unlocks the next expensive step, building the cell. A modern landfill is constructed in phases. The owner does not normally excavate and line the entire property on the first day. Individual cells are developed as capacity is needed, which spreads capital spending across the operating life of the site. Each cell needs barriers beneath the waste, pipes to collect contaminated liquid, roads for heavy trucks, and equipment capable of crushing an unstable mountain into dense layers. Filled sections need cover. Gas and groundwater still need monitoring. There is no honest national price tag for all of this because geology, cell depth, liner design, labor, drainage, and project scope vary so widely. Consider two public examples. In 2022, Minot, North Dakota, estimated about $2.36 million for construction and design of a new cell. A 2024 Charlotte County planning estimate implied $20 million to $30 million for its minimum 20-acre expansion. Those examples are not contradictory. They are evidence that what does a landfill cost is incomplete without the location, scope, design, and amount of capacity created. Acquisition prices are just as difficult to compare because deals often bundle landfills with trucks, transfer stations, customer contracts, and expansion rights. A buyer has to separate what is being paid for the property from what is being paid for each remaining ton of permitted capacity. The timing of that spending creates a dangerous illusion. A landfill may report healthy operating income while it should be saving for the next cell. Distribute all of that cash as profit, and the business can look successful right up until another multi-million-dollar construction project comes due. Only after that capital is committed can the scale house begin turning trucks into revenue. When a vehicle arrives, the scale records its weight, waste category, and origin. Those details determine the tipping fee. In the Environmental Research and Education Foundation's analysis of 342 U.S. facilities, the unweighted average tipping fee for 2023 was $56.80 per ton. The ton-weighted average was $57.63. But the national average hides a much more important story. The reported regional average was $43.18 in the Southeast and $84.44 in the Northeast. The same ton of ordinary municipal waste could therefore generate dramatically different gross revenue depending on local capacity, regulation, land availability, competition, and transportation alternatives. Charlotte County provides an even sharper example of customer classification. Its presentation listed an in-county rate of $39.28 per ton and an out-of-county rate of $78.54. Same facility, same general disposal function. Nearly twice the rate based on where the waste came from. The posted gate price may not equal the realized average. Large haulers negotiate, municipal contracts set their own terms, and some waste costs more to handle. The owner is selling units of capacity with different prices and different risks. Now put the national ton-weighted figure into a hypothetical standalone landfill. Assume the site accepts 300,000 tons per year at an average of $57.63 per ton. Annual gross tipping fee revenue would be approximately $17.29 million. That sounds excellent until the word gross is placed in front of it. At the Southeast Regional average, the same 300,000 tons would generate about $12.95 million. At the Northeast average, it would generate about $25.33 million. The difference is roughly $12.38 million per year before changing the number of trucks, employees, or tons. The same landfill design can therefore produce radically different economics in a different market. And temporary surges from construction or disaster waste can raise current revenue while burning through years of capacity faster than planned. A $10 change in the realized price on 300,000 annual tons changes gross revenue by $3 million. A 10% change in volume changes revenue too, but it also changes how quickly the landfill runs out. Price and volume therefore behave differently. Higher price increases revenue without directly consuming more inventory. Higher volume increases revenue by selling more inventory. If the additional tonnage is underpriced, the owner may celebrate a busy gate while destroying long-term value. The next calculation is remaining life. Twin Oaks Landfill in Texas presented a planned expansion of roughly 30 million cubic yards, equivalent to about 22.5 million tons. That relationship implies approximately 0.75 tons per cubic yard for that specific planning example. At 500,000 tons per year, the additional capacity was expected to provide about 45 years of life. Use that same site-specific density only as an illustration. If our hypothetical landfill has 10 million cubic yards of remaining airspace, and if it achieves 0.75 tons per cubic yard, It has space for approximately 7.5 million tons. At 300,000 tons per year, the simple estimate is 25 years of remaining life. But the word simple matters. Future volume could grow. Density could change. Settlement might create additional usable space. Regulators could alter design requirements. A vertical expansion might be approved. A lateral expansion might fail. A storm could send an unexpected wave of debris through the gate. Landfill life is not just a date printed in an engineering report. It is a financial forecast built from physical assumptions. This is also where integrated waste companies gain an advantage that a standalone owner may not have. During 2025, Republic Services reported that approximately 67% of the solid waste volume it collected was disposed at landfills it owned or operated. That process is known as internalization. Owning the collection route gives the company influence over the destination. The customer pays for collection. The truck transports the waste, and the company can direct the material into its own disposal network where capacity exists. A standalone landfill without collection operations depends more heavily on third-party haulers. Those haulers can redirect loads if a competitor offers a better combination of price and distance. And distance matters because waste is expensive to move. Fuel, driver time, vehicle wear, transfer stations, and traffic all shape the practical service radius. This creates another hidden product. A landfill does not only need airspace, it needs reliable access to waste. Some volume is protected by contracts. Some is controlled by owning the collection company. The rest can leave after a competitor changes its price. An owner has to know the difference. Capacity without volume produces no gate revenue. Volume without capacity consumes the asset too quickly. The owner is constantly balancing the two. Then, years after waste has been placed, decomposition begins producing another potential source of value. Landfill gas is roughly half methane and half carbon dioxide, with smaller amounts of other compounds. Because methane can be burned or processed, a landfill may collect the gas for electricity, direct industrial use, or upgrading into renewable natural gas. That sounds like free revenue rising out of buried garbage. It is not. Gas wells, collection piping, blowers, treatment equipment, monitoring systems, pipeline connections, engines, and ongoing maintenance require capital and expertise. The amount and quality of gas change over time. Electricity contracts, natural gas prices, renewable fuel credits, state incentives, interconnection costs, and regulatory requirements can determine whether a project works. The EPA maintains a database containing hundreds of operating landfill gas energy projects, but the existence of a national industry does not make every individual site economic. Republic Services reported 77 landfill gas-to-energy projects at its landfills at the end of 2025, with more than 30 additional projects in development. Most of the operating projects it described were developed, owned, and operated by third parties. Republic supplied the gas and earned a royalty. That structure tells us something important. The landfill owner does not always need to become an energy developer. A royalty can reduce capital exposure and technical risk, but it also means sharing the economics. Gas revenue should therefore be treated as site-specific upside, not as a guaranteed line in every landfill valuation. And before calling landfill gas a magical second business, consider the obligation sitting on the other side of the ledger. At the end of 2025, Republic Services recorded approximately $2.313 billion in liabilities for landfill final capping, closure, and post-closure care. Its estimated remaining future payments, stated without inflation and without discounting, totaled approximately $8.734 billion. That is not a bill due next year, and it covers a huge portfolio over many future decades. It includes obligations already recorded, as well as costs expected to be incurred as the remaining landfill capacity is consumed. Still, the scale of the number destroys the idea that a landfill simply fills up, closes the gate, and becomes somebody else's problem. Before closure, an owner may try to create more inventory. Expansion can be vertical, allowing waste to reach a higher approved elevation, or lateral, extending disposal into a new area. A successful permit can add millions of cubic yards without requiring the company to assemble an entirely separate operating network. That makes expansion one of the most powerful value creation events in the business. Imagine a landfill with only 5 years of permitted life. Customers, roads, scales, equipment, and employees may all be in place, but the income stream has an approaching expiration date. If regulators approve another 20 years of capacity, the same operating platform suddenly controls far more saleable inventory. The value increase is not free. New cells require construction, opposition can intensify, and management may spend years pursuing an expansion that never receives approval. That is why public waste companies distinguish permitted airspace from probable expansion airspace. A buyer who pays as if every proposed cubic yard is already approved is accepting the seller's regulatory risk. Remaining life also changes how a landfill should be valued. Two facilities can produce identical cash flow while one has 30 years of capacity and the other has 4. Current earnings do not capture that difference. A useful acquisition question is not simply, what multiple of EBITDA am I paying? It is, what am I paying for each remaining permitted ton? And how much cash will that ton produce after its share of operating, cell development, and closure costs? That question connects the income statement to the physical asset. Eventually, however, additional capacity is denied, exhausted, or no longer worth developing. The final truck leaves. Revenue from active disposal may stop almost immediately. The owner's obligations do not. Filled areas must receive final cover. Systems that manage methane, leachate, groundwater, stormwater, erosion, and settlement have to be maintained. Samples must be collected, analyzed, and reported. Problems discovered years later may require corrective action. For municipal solid waste landfills, the required post-closure care period generally runs for 30 years, although an approved state authority may shorten or extend it based on conditions at the site. Republic reported responsibility for 124 closed landfills at the end of 2025. Those sites no longer represent active disposal inventory, but they remain part of the company's financial and operational reality. The accounting attempts to recognize this gradually. As airspace is consumed, large operators record portions of expected final capping, closure, and post-closure obligations. In simplified terms, every ton carries a fraction of a future bill. The corresponding cost is not supposed to appear for the first time on the day the gate closes, but estimates can change. Future labor and material prices may be higher than expected. Monitoring may continue longer. A gas or leachate system may require more maintenance. Environmental rules may become stricter. Actual remediation can exceed the amount originally modeled. Engineering estimates can improve, and a gas project may offset part of the expense. But a closed landfill is neither automatically worthless nor automatically valuable. Its future use remains constrained by what lies underneath. This is the deepest ownership risk in the business. The revenue is collected in the present, while part of the final cost remains uncertain for decades. Now we can assemble the owner's spreadsheet. Return to the hypothetical landfill, accepting 300,000 tons annually at $57.63 per ton. Gross tipping fee revenue is approximately $17.29 million. The rest of the model uses assumptions, not industry averages. It allows for ordinary operating costs, a reserve for closure, fixed overhead, and the next round of cell construction. After those deductions, only about $2.19 million remains. Not net income, not owner take-home pay. Pre-tax, pre-debt cash before the acquisition itself, unexpected remediation, or an energy project. Now comes the turn. Raise operating costs by just $5 per ton, and $1.5 million disappears. The apparent cash flow falls to roughly $690,000. One small change has erased most of the result. More volume does not automatically rescue the owner either. A 10% increase adds only about $619,000 in the base scenario, while cutting more than 2 years from the simple capacity forecast. The gate looks busier. Revenue is growing. The asset is dying faster. That is the number a conventional income statement struggles to show. A landfill can grow while destroying value if the extra waste is priced too cheaply for the space it consumes. Now add acquisition financing, and that line moves higher. The real debt service cannot be calculated without inventing a purchase price and loan structure. That is exactly why a universal landfill profit claim would be dishonest. If a buyer finances a high price for a landfill with limited remaining capacity, debt can absorb the cash that should have funded the next cell. If the buyer contributes more equity, annual debt pressure falls, but the return on invested capital may still be unattractive. Gas royalties could improve the result. Higher special waste pricing could improve it. A successful expansion could transform it. Lower regional tipping fees could destroy it. A lost municipal contract could destroy it. Unexpected remediation could overwhelm it. The attractive case is a site purchased at a sensible price with long permitted life, dependable nearby volume, room to increase rates, efficient compaction, credible expansion potential, and environmental obligations that have been carefully measured. The dangerous case is a landfill purchased on current EBITDA while the buyer ignores how little permitted inventory remains. That leads to the ownership verdict. A landfill can be a durable and strategically powerful business because communities produce waste in good economies and bad ones, and permits restrict how quickly new competition can appear. The owner may collect recurring gate revenue, protect volume through collection routes, and earn additional value from gas or expansion. But this is not permanent passive income attached to cheap land. It is a shrinking legal right supported by expensive infrastructure and followed by long-lived obligations. The most important number is not the size of the property, the number of trucks in line, or even this year's profit margin. It is the price paid for each remaining ton of permitted capacity, after accounting for what that ton costs to receive, compact, contain, cap, and monitor. If that calculation works, garbage can support an extraordinary asset. If it does not, the owner may spend years collecting cash from a business that is quietly consuming the very thing that made it valuable. And that raises a related question. If controlling the waste stream protects the landfill, could owning the collection routes be safer than owning the final destination?